Hi, everyone. Good afternoon. I'm Will. As you may have guessed that I'm up here looking like a bit of a narc, I am the voice of TradFi this afternoon for the panel. Yeah. And I am from Dragon Capital. We're Vietnam's oldest and largest asset manager. But I don't want to talk to you about Dragon. Before this panel, I want to tell you a little bit about myself. Not to flex, not to humble brag. In fact, it's a bit shameful because my career started as a structured finance banker. All the stuff that blew us up in 2008. All right, thank you. Sorry, is that better? Do I have my radio voice now? All right, welcome. All the stuff that blew us up in 2008, if we got all CSI on it with black lights, my trace DNA would be everywhere. Why is that? Because when I started my career, securitization was not DeFi, but it was the new fi. It was cool, it was exciting. It was supposed to be better than the traditional finance that was out there. You know what inspired me to go into securitization? How many of you know David Bowie? Who knows Bowie? All right, good. I see my Gen X peeps, I see some young people with good musical taste. So David Bowie, sorry, pardon my potty mouth. David Bowie, a musical genius, in 1996 securitized his song catalog and used that money to invest in this crazy little thing called the internet. He took one asset and turned it into a security, and that blew my mind. It absolutely blew my mind because it created value, it created access. Does this sound familiar? And so we went from this vision of having something that was better than the traditional finance to the financial crisis where Warren Buffett labeled us weapons of mass destruction. Why is that? So today our panel is about institutional adoption of RWAs. And honestly, this panel is not to argue their merits. For me, the case is clear. What this panel is to discuss the roadmap that takes us to the adoption in a way that is scalable, sustainable, and ultimately creates utility for all members of the value chain. So with us today, we have a really interesting cross-spectrum of different stakeholders in that value chain. And our objective is almost to reach a Da Nang consensus that we could publish as a white paper and say, here's a roadmap to take us to the application of tokenization at scale in a way that learns from and builds upon the failures of securitization some 15, 20 years ago. That's our vision for today. Let's see if we get there, gang. So, first of all, I believe we are going to talk about custody. Let me tell you a little anecdote. First batch of Bitcoins I ever bought, lost to the FBI when they shut down Silk Road 1.0. Second batch of Bitcoins I ever bought, I lost to Silk Road 2.0 when the Dread Parrot Roberts 2.0 invented the rug pull. Third batch, collapse of an exchange in Hong Kong during the first crypto winter. Clearly, I am not meant to own Bitcoins. However, what that has sensitized to me too is the importance of custody. And Stacey, I'd ask you to introduce yourself and Zodia a little bit, but custody is the unsung hero of keeping everything together. It's that backbone that makes us all work. As we work towards that vision of a Da Nang consensus, what are your thoughts on the key elements of custody that add that sustainability, that robustness, that ability to give people the confidence that's needed to achieve scale?
Thanks so much. Good afternoon, everyone. My name is Stacey-Ann Pearson. I work at a company called Zodia Custody, so I run the Singapore and Hong Kong businesses. So maybe just a little bit of context here. For Zodia Custody, we sit right in the middle between TradFi and crypto. Why is that? Because we were created by banks, and our cap table is full of banks. So we were created by Standard Chartered. We currently have 4 other banks, including, Australian and UAE national banks. So the reason we were created is to serve traditional financial institutions and mature companies, especially mature companies in crypto that are looking to service enterprises and regulatory compliant firms. Right now, as our moderator mentioned earlier, that we have scenarios where companies are looking at self-custody and where they're looking for a custodian. As the market changes to include stickier institutional money, we see that there is a requirement for third-party securities or safe safety wallets for institutions. Because if you imagine that you are a Fortune 500 company, you are the risk team that is approving purchase of top 10 coins, who are you going to give a ledger wallet to, or insert X number of wallets? That's a disaster waiting to happen. Either that person's going to get kidnapped, or they're going to run away voluntarily with the company's monies. And so we see that role for the custodian in helping to bring that institutional flows into the ecosystem, to open up opportunities for the crypto native companies to then be able to provide good services on top of that capital.
Interesting. Look, if we build upon that then turning to you, Rania, I mean, you heard me talk about the Bowie bond. That was unique. At the peak of the securitization markets, we saw everything from sort of the vanilla end of credit cards through to the spicy end of love hotels in Japan. Very unique cash flows to securitize. I mean, with the work that you're doing at Ondo and the work in money market funds and in T-bills and in listed equity, what is your perspective on what's needed to scale out? Perhaps both in terms of assets, in terms of structure, and really, what's the core to this great adoption question we've been wrestling with these 2 days?
Yeah, thanks a lot, Will. So maybe just to set the stage a little bit and introduce Ondo Finance, we are the first and one of the leading issuers of tokenized US Treasury bills. We have 1.3 billion of TBL across our retail and institutional product. To kind of steal a line that Stacey has actually used, we like to see ourselves as the bridge between traditional finance as well as crypto native players. So I think to kind of answer your question, and I cover sales and BD for Ondo Finance in Asia. So yeah, to kind of answer Will's question, I think even a year or 2 years ago, people would be asking the question of why? Like, why do we need even tokenized assets on chain? And this year, what we've really seen is a remarkable change. It's no longer what or why, but how. How can we get into this? And the reasons is I think more and more people are starting to see the benefits of having these financial assets kind of on chain. We bring about operational and capital efficiencies that we cannot actually see in the real world. And one of them is just simply the case of just low cost. We enable instant 24/7 mint and redemption with one of like products. That is not something that you can do in the real world because of either trading hours or even the bank fiat rails. What we, however, think is needed to take this to kind of the next step is definitely a lot more of education, awareness, and a lot more players, the like of Zodia, Ondo, really bridging the gap between those who want to do this and those who want access to them.
Thank you. Leon, you'll introduce yourself in a moment, but for the audience's benefit, Leon's a bit of an OG here on stage, right? Has had a position of both influence and I don't know, what should we say, oversight in terms of the evolution of what we're talking about here today. From your sense, what are the tipping points for adoption? And are there models or are there asset classes that your sense would say are more likely than others?
I think when people talk about RWA and tokenization of assets, I think there are two key components that have been covered by my co-panelists. I think in terms of trust, that the custodial element is super important. And I think today we look at institutional grade custodians that even provide insurance, right, on a per wallet basis. These products and services are already out there. So it covers the trust aspect. I think the other element is access, right? Whether it's kind of 24/7 access, whether it's kind of ease of onboarding in terms of allowing people to buy tokens versus traditional securities. Crypto or even the blockchain has provided a lot easier access in terms of the overall onboarding experience, right? And I think everyone in this room would probably agree that it's way easier to buy a token than to even onboard to say buy a Australian stock or even a Thai stock, right? In today's capital markets. But I think what's still really missing are the other elements of why people actually invest in real world assets, right? And I think there are three key components that people really need to understand. Number one is volatility, right? People want to invest in assets because sometimes they want to be able to hedge or actually have exposure to volatility. The second part is liquidity, right? How much liquidity does the underlying asset have? And that's often a function of mandate, right? And I think the key issue now here is a lot of hedge funds, right, globally, still don't have a mandate to actually invest directly into tokens. And that's not because tokens are unattractive, right? It's just because the mandate, when they raise money from external LPs, just do not give them even the choice to look at some of these assets. And I think beyond liquidity, the third thing is really price action, right? How much kind of participation and upside there is relative to principal protection. And I think, a key strategy that our group and fund has recently really looked at is really replicating kind of MicroStrategy success across Asia, Southeast Asia, and also North Asia. And our key learnings here are that in each capital markets, we believe there's a huge opportunity for tokens to be part of a treasury play, right? And effectively, these are just leverage crypto plays packaged in the form of a traditional security. But why is that attractive, right? Number one, because it creates that volatility that maybe typical traders are afraid of, but the volatility actually gives people price action. So if you look at the likes of MetaPlanet, Soul Strategy, right? That additional volatility actually creates a lot of opportunities to run delta neutral strategies, which hedge funds actually really like, right? I think today, for example, if you look at MicroStrategy, there's actually a separate index even called MSTY, which just makes it so much easier for people to invest in covered calls, right? But
Visibility,
right?
transparency.
But MSTY is not tokenized yet. What if I can offer a similar product on every single crypto token that allows me to benefit from the covered calls, right? That risk premium from actually selling, insurance or selling protection on tokenized assets, right? So for me, that's probably still the element that's missing in today's market. That I think hopefully, with the rise of so many of these treasury-based assets, I think the next step is to actually tokenize them and make them available on the blockchain.
Can I add something?
Please jump in there, Stacey. No, okay, no. Stacey first, Rania second.
Yeah, sure. Because there are a couple of amazing points that were brought up, and one of them that I want to double click into is the idea about the capital allocation, especially of traditional funds today. So today we do see a lot of family offices, hedge funds that are from the traditional side that have 1 to 5% risk appetite for pure play crypto tokens. All of a sudden, when you see this RWA side, the tokenization side, that opens up the 20 to 30% allocation that some of these funds have to fixed income. And that's something that's really powerful for the crypto community, because as we are creating these new products, now some of these funds are open to holding some of these asset classes that are in this sphere because they have that allocation around fixed income. So it's really quite interesting what we're seeing, because we get access to institutions that crypto natives don't usually get access to. So think sovereign wealth funds, family offices, country level banks or development banks. And these are the things that they are quite interested in, not just for themselves, but also for their more sophisticated clients. So I think it was a really powerful point that you made here.
Yeah, and Rania?
Yeah, just wanted to also add on, I think a lot of great stuff there. It needs to unpack, but I think one of the key things that really struck out, this idea of like legal protection that you mentioned, and I think one thing that's really unique about RWAs is we're the only real asset classes that combines the benefits we see in DeFi, like the DeFi use cases that you can do on chain, and the legal protection that you actually see in real world, like bankruptcy remote structures, so users actually have a right to the underlying assets should the case of the company that issues a token goes kind of down under. And I think it's, we really talked about different types of asset classes that will emerge. And if I really think about this, the way we kind of think about the evolution of this is the first product that really achieved product market fit in the RWA category is the US dollar via stablecoin. And of course, this is timely because Circle just did their IPO and their stock price surged 200% from the listing. And in a way, we don't find that surprising because that just reflects the market sentiment and how people really feel about this sector as a whole. And stablecoins are so popular because it is, the US dollar, but on chain, it is fast, it's convenient, it's efficient. But then people start thinking, like, what is next? And that's kind of how, Ondo was like the first issuer to tokenize US Treasury bills, because holders of stablecoins, we believe, should have the right to the native yield and not actually get the issuers who just pocket them all by themselves. And even in the last year, since we started talking about this, the US Treasury bills kind of market cap is now sitting at 7 billion. It was just over like 1 billion not too long ago. And we anticipate, more of the type of asset classes that we talk about coming on chain.
So let's build on that. I mean, an open question to the panel. What comes next, right? If you look, again, let's look at the parallel securitization markets. It started with consumer credit, mortgages, credit cards, all the agency stuff. then it moved into corporate credit, different types, and then it moved into the repackaging of credit, all the leverage structures that blew us up. What's the next step? Yeah, you know, if we start with T-bills, most liquid asset class on earth, natural starting point, but what comes next? And what are the frictions to the adoption that are stopping from what's coming next? Either coming or to some of what the two of you just addressed right now, the momentums that are supporting the pull, right? The demand as well as the supply.
Yeah, happy to take this. So, you know, as I mentioned, the way we kind of see the evolution of RWA, starting from stable coins to treasury bills, and the next thing that we're incredibly excited and bullish on is actually U.S. public equities. So the way we see it is treasury bills is the one that has the most liquid, it's the most kind of risk-free sort of asset that we deem. And public equities is the same. You know, it has the highest demand, trillions of dollars worth of assets in the real world. And yet there are some inefficiency that we see that we think the on-chain can actually seek to address that, and notably being operational and capital efficiency. We don't kind of believe the sake of tokenizing for the sake of tokenizing. People want to bring all sorts of asset classes on chain, and sure, but the question is why? If there are assets that cannot be sold in the real world, what makes you think there are buyers on chain? These are, you know, incredibly sophisticated and smart buyers too. There must be a reason why they want to access the products on chain, and that's precisely what we're trying to do. So take for, you know, public equities, for example, it's a sort of DeFi use cases that we're envisioning to come on chain that we haven't seen yet. Take for example, you know, today you can obviously take your kind of asset, deposit it into a borrow and lending pool, borrow out stable coins, and then sort of conduct all sorts of different trading strategies to be more capital efficient. Today, in the real world, if you hold a whole bag of Tesla stocks, maybe you hold 3 million worth of them, can you go to your bank, HSBC or JP Morgan, and say, can I take out a mortgage if I deposit my tokenized stocks with you? And most likely they'll tell you, go away. Or maybe they haven't been thinking about that. But that's the sort of future that we're envisioning on chain. Lots more capital and operational efficiencies that we don't see yet.
I see burning answers from Leon and Stacey, but just before that, I think there was a great observation yesterday on the GameFi panel that part of the failure of the first cycle of GameFi was that the peak of each project was the token launch and no utility thereafter. And what you've articulated there, Rania, is a very clear vision of not just launching the token, but the utility in multiple levels and for multiple stakeholders are created thereafter. Leon, did you want to build on some of what Rania was saying?
Yeah, no, I think one thing that stands out is obviously the wide adoption of stable coins. Some of the biggest owners of treasury bills are actually companies like Tether, right? And I think gradually that will only go up. And if you understand the stablecoin market, a lot of times it's effectively just a kind of collateral debt obligation, right? There's debit, there's a credit. Then the question then is, okay, if I hold a stable coin, and how can I generate additional yield on it? And I think one of the, you know, kind of historically strong, you know, kind of opposition against crypto assets is the fact that they're highly volatile. But you actually understand the derivatives market or the options market around crypto, is that volatility actually means higher yield when it comes to options premiums, right? And what we're seeing now in the market is that a lot of people are actually leveraging that volatility to run delta neutral or market neutral strategies that actually offer you even high double digit APY yields, right? That's delta neutral, but they can be fully hedged out. What I would like to see as a future is actually having a lot of these kind of structured products being tokenized and actually made widely accessible to people who want to hold it on chain.
I definitely want to build on this point because this is something super interesting for us. We were just speaking with a global top 3 investment bank that is quite active, let's say, in the structured products market for crypto. And one of the things that I'll say from what Rania said earlier and what Leon said, when you think about the traditional market, right, crypto is early, but it follows the same arc of the traditional market, right? So as we come up with new innovations, you check the TradFi side, it's there already, right? And we've, you know, brought it into the crypto side with a little bit more liquidity, 24/7 markets, etc. What are some of the most profitable products on the TradFi side? A lot of people will know that this is lending, borrowing in different flavors, right? Whether it's a margin loan where you borrow a bunch of money to take a big bet and then get a lot of upside, or if it's just on an asset-to-asset trade like what Rania was talking about earlier. And so when you insert the RWA or the tokenization component, the thing that we're most excited about is seeing how those profits can then be generated on the crypto native side. So for example, you see a crypto native fund that's looking to do a risky trade, but let's say they only have tokens, but the person who's going to lend them the money doesn't accept tokens. They want something more stable, maybe a tokenized MMF. All of a sudden, that fund can borrow 2-3 times what they usually would be able to borrow, because now they can utilize tokenized MMFs because they don't have fiat and the lender doesn't want to take crypto. So these are some of the really interesting unlocking mechanisms that RWA really brings to the crypto ecosystem, because it allows individuals, it allows companies to start to take better risks, and because they're interacting with TradFi players, they have to take risk-adjusted bets, which is something that we're not always used to on the crypto side.
Yeah.
So that's a really fascinating development that we are helping to support with collateral management and then building the ecosystem around what some of these more complex structured products could look like.
And that's really interesting, and I think that's what we're getting to, is ecosystem building. And if we think about an ecosystem, let's break it down into a few components. There's the supply, there's the demand, there's the medium of transfer, and then there's the regulations that sit on top of that, right? Where is the friction? If we take into just those 4 simple pieces, where do you see the frictions that is stopping the adoption of all these great things we're hearing about? And what are the key, like if you can say, what's the one key next step to address that? What would that be?
I wouldn't necessarily call it friction. I would think more regulatory clarity would be helpful. I mean, just even in the context of, I guess, the Vietnamese market, I understand that there's a new framework for even exchanges to operate coming into effect in the next few weeks. And I think this is just an inevitable part of the journey as the industry evolves and matures. What is really needed, I think, to scale and grow for this ecosystem, just to add on also what Stacey-Ann has mentioned, I think it's a really important part, which is players like ourselves sitting in the middle. We understand both sides and we see what is needed to actually enable greater adoption.
Beyond, any thoughts on that, or Stacey?
Yeah, I'm happy to jump on this one. So Rania mentioned a fantastic one. One that we come across very often is, you think it's quite simple, is operational and compliance efficiency. So what do I mean by that? So very often when we are doing RFPs or due diligence for our TradFi clients, anyone want to take a guess how many questions they ask us in order to vet us as a company? Is it like 10? Is it 30?
80.
100 plus.
170 questions is the average of the due diligence questionnaire that we have to fill in order to interact with these TradFi players that are getting into crypto. Not a lot of crypto native companies have the patience or the team in order to fulfill some of these requirements. And you know, our pack ends up being 200, 300 pages long, and it takes like 3-4 months of the company to do due diligence. And so a lot of crypto native companies have to recognize that in order to unlock this sticky institutional money, either you need to work with a player like us or like Ondo or other teams that have these kinds of compliance people that are able to fill out these requirements, or you need to build it yourselves, or forget about the institutional money and just stick with crypto native. So that's one thing that we try to educate crypto native founders and teams, is when you're working with these insties, that compliance and operational readiness is ground zero. You cannot go even further. You can't even get into the first meeting without this layer. And that's not yet something that's spread across the ecosystem.
And just to add, I think, I'd like to go back to first principles, which is, I think one of the key friction points that still exists is actually the fiat to crypto and crypto to fiat rails, right? And I think, these institutional and compliant players, for example, such as Zodia, they have made it a lot easier. But if you ask anyone who's actually run a crypto fund, whether it's kind of prop or even VC, setting up a banking channel for crypto firms is just incredibly painful and takes a long, long time. And offshore banking channels just aren't great, right? And I think that fundamental friction point, despite all the regulatory tailwinds that are driving kind of crypto forward, I think the fiat to crypto, effectively the gateways, still need to be tremendously improved on.
Look, we see a lot of opportunity here, and this is really exciting, but it's often observed that you don't really have a grasp of the opportunity without being able to articulate where it could go wrong. And I think this is not about doom or gloom, but I think it would be interesting just to think through, with so much opportunity, what are the risks, either systemic or episodic? You know, what are the things that we think could stymie adoption? It could be simply as there's better opportunities elsewhere. What risks do you see, the three of you see at this point in time?
I mean, for us, it's definitely the issue of compliance. I think Stacey has mentioned the extensive process that they have go through in working with traditional finance players, and it's not dissimilar from us. Essentially, we are issuing tokenized financial products, and that actually means that the way we distribute that, the way we ensure users can access them, has to be still compliant with the framework in the real world. So again, navigating this balance and how this RWA sits in the middle of that is still a very key part of what we do.
So the realities of the intersection, okay. Leon, how about yourself? Thoughts on risk?
Well, I think eventually it's still transparency in the overall industry. I think greed is probably still the biggest risk in our industry, right?
Greed and
People
fear is the
chasing
basis of it all.
outsized yields that are not sustainable. People chasing outsized leverage plays, which we do see in the market, and fundamentally really understanding how leverage works, right? And there's always a trade-off between upside participation and how much downside risk there is. I think people try and chase the best of both worlds, where hey, I want maximum upside protection, but at the same time, I don't want to take principal risks. That's just impossible, right? Do the math, really understanding the risk trade-off curve. I think it's super essential for anyone that actually wants to be in this industry.
You know, just before you answer, Stacey, the one absolute truth I learned 20 years as an investment banker, everybody's a sophisticated investor till they lose money. Then I was missold, I didn't understand, the docs were wrong, so point well made, brother. Stacey?
Yeah, so really closely linked to what Leon mentioned, credibility and reputation. I cannot tell you, and Rania mentioned it before about education, I cannot tell you how many times we've entered the rooms in TradFi where the first thing they quote to us is some hack or some, scam coin or meme coin, etc., that, they came across that is driving fear into the hearts of the risk officers that are in that company. Now, I'm not going to sit here and lambast, the meme coin community or, the degen side of our community, right? It's part of the experience. But I think the component of actual true adoption and stickier monies, in order for us to really get that, we have to have a plan around how do we build the credibility and reputation of the entire ecosystem. Because that is one of the biggest blockers that we see when doing business or trying to do business with stickier institutional money. I'll give you a very quick example. We were at the end of a deal with one of the banks, I won't say where, and the final approval sat with the chief risk officer, and he retired. He was about to retire, so 2 weeks into retirement. So we were like, okay, fine, we'll wait 2 weeks. The new chief risk officer will come in. That new chief risk officer came in, and I was like, my first decision is not going to be to purchase crypto.
Oh yeah, the career risk is way too high.
That deal died on the desk of the final leg after 7 months of work, simply because of that fear, inherent fear of the potential credibility issue of making your first decision engaging in crypto. So those are some of real blockers that we're seeing in real life.
Sorry, just quickly, business continuity, as in the continuity of somebody's ass on their chair in an institution, is a big distorter of behavior. Look, Rania, just before you jump in there, we've only got a few minutes left. What I'd love to ask of the panel is for you to really give your final elevator pitch to the audience about what's important. But more than that, what do you ask of everyone here to do next? What is it that we as a community need to do to drive this forward? So Rania, let me bridge to you there.
Thank you. Great question, and actually that ties in with what I really wanted to add on to Stacey's point about education. My mom always shows me any newspaper article that she sees, crypto scams, fraud, hacks, and it comes to a point where I try to explain to her, major cryptocurrencies like, blue chip ones like Bitcoin, Ethereum are very different from meme coins, and by the way, that's also very different from RWAs, but in her mind, they're all in the same category, they're all the same thing. So I think there's a lot more of education that really needs to be done in this space, and I really think that we've really seen that over in the last few years. You know, Coinbase IPO was 4 years ago. We just saw Circle yesterday, and a lot more consolidation in the industry as well. And I think we're all taking the right steps.
So call
for
to
mass
action,
adoption.
teach, educate.
Thank
Leon?
you for turning up. Yeah.
Yes, thank you for
100%.
turning up. Turning up after lunch on day 2, thank you.
And I think to follow up on the note of education, I think just understanding the importance of liquidity and depth in markets. Right? A lot of people like to chase views, but they don't understand the concept of capacity. And I think for us, bringing new liquidity to crypto is so important, and that's why I think being able to unlock the liquidity from fixed income, which is almost like a $300 trillion asset class, into crypto, is key to really improving the overall liquidity health. Right? What we've seen in the last cycle, even with FTX, was that the lack of liquidity actually killed the exchange. Right? And in crypto, everyone talks about kind of high FTV, low market cap, low liquidity tokens. I think even when it comes to kind of traditional securities, right? In Asia, there are many high market cap companies that barely have any daily trading volume. So for me, it's really bringing that organic liquidity back into the market. That's going to be super, super important, driving that adoption.
Call to action from Leon then is to truly understand the markets, know what you're getting into, to just follow the high level numbers. And Stacey?
Yeah, my advice is simple to understand but difficult to execute. Is if you're a builder in the ecosystem, build with security and longevity at top of mind. Don't take the easiest route that will get your product launched quick, but it's open to hacks, it's open to compliance issues, because that's going to come back and bite you in the butt on the long term.
So build for robustness. Yeah. All right, well look, I'm an old man who spent his career in TradFi, and I have been overwhelmed by this panel. I have been convinced and compelled and comforted for the vision. So everybody, please join me in thanking them. I think it's been a great vision. Thank you very much, everyone.